China's economy just posted its weakest quarterly growth in over 3 years, and the number itself only tells half the story. Gross domestic product expanded 4.3% year on year in the second quarter of 2026, missing the government's own 4.5% forecast and falling short of an annual target range that was already the lowest Beijing has set since it began publishing growth figures in 1991. Overall growth for the first half of the year came in at 4.7%. This is not a country failing to grow. This is a country failing to grow the way it wants to. And the gap between those two things is where the real story lives. Look closer, and the picture splits into two economies moving in opposite directions. On one side, exports surged 17.6% in the first half of the year, with June alone posting 27% growth, driven by artificial intelligence hardware, semiconductors, and electric vehicles pouring out of Chinese factories at a pace no other nation can match. On the other side, retail sales limped to a bare 1% increase in June, a rebound from an outright decline in May, the first monthly contraction in consumer spending since December 2022. Beijing is winning the factory floor and losing the shopping mall, and that imbalance is now the defining feature of Chinese economic life. Analysts covering the release put it plainly. Growth remains powered by manufacturing, not by the consumption-led rebalancing Chinese leadership said it wanted when it set this year's targets. And the reason is structural, not seasonal. For 2 decades, Chinese growth ran on a simple engine: cheap land, cheap credit, and a property sector that ballooned to nearly 30% of GDP at its peak. That engine seized up starting in 2021, when regulators imposed debt limits on developers to curb speculative excess. Evergrande defaulted with over $300 billion in liabilities. The contagion spread to dozens of other builders. New home prices have now fallen for roughly 20 consecutive months, and the most recent data still shows prices declining, just marginally slower than the month before. An entire generation of Chinese households parked their savings in apartments that were supposed to only appreciate, and instead watched that wealth evaporate. No amount of stimulus has reversed that psychology, because the problem was never really about liquidity. It was about trust in an asset class the entire economy had been built around. That single fact explains almost everything else in the data. Chinese consumers are not spending because the asset they were told would only appreciate has instead collapsed in value. Local governments are not investing because roughly a third of their historical revenue came from selling land to developers who no longer want it. In 2025 alone, interest payments on local government debt grew nearly 7% year on year, outpacing the official GDP growth rate itself. Estimates of total local government debt run as high as $13 trillion once hidden and off-balance sheet borrowing is included, a figure that dwarfs the explicit numbers Beijing publishes. That is not sustainable arithmetic. That is a treadmill running faster than the country underneath it. And every year, the debt service bill grows a little larger relative to what the economy can actually generate. Deflation compounds the problem. China has experienced falling or near-flat consumer prices for close to 3 years, an almost unprecedented stretch for a major economy outside of Japan's own lost decades. Falling prices sound benign to outside observers, but inside China, they function as a trap. Consumers delay purchases expecting further price drops. Businesses cut wages and investment to survive shrinking margins, and the entire cycle reinforces itself. The recent spike in global energy costs tied to the Iran war briefly nudged Chinese inflation upward and technically helped pull the country out of one of its longest deflationary stretches on record. But that relief came from an external shock in the oil market, not from a healthier domestic economy. It is worth noting how strange that is. China needed a war on the other side of the world to temporarily solve a problem stimulus at home could not fix. Layered on top of this is the youth unemployment problem Beijing would rather not discuss in detail. Official urban unemployment sits around 5.1%, a figure that has stayed suspiciously stable for months. But the unemployment rate for workers aged 16 to 24, excluding students, has been tracked at close to 17% for much of this year, and some independent estimates put it higher. That number briefly exceeded 21% back in 2023, at which point Chinese statisticians simply stopped publishing it for several months before returning with a revised methodology that produced smaller, more politically comfortable figures. Millions of university graduates are entering a labor market where manufacturing is automating, services are stagnating, and the property construction jobs that once absorbed excess labor have largely vanished. For a generation raised on the promise that education would guarantee upward mobility, the mismatch between credentials and available jobs is becoming one of the more quietly destabilizing forces in Chinese society. None of this means China is collapsing outright. Its factories still produce more steel, more solar panels, more lithium batteries, and more electric vehicles than any other country on Earth. And its trade surplus hit roughly $1.2 trillion last year, a figure so large it has triggered trade friction with governments across the world trying to protect their own manufacturers from a flood of subsidized Chinese exports. The International Monetary Fund actually raised its 2026 growth forecast for China slightly to 4.6%, even while projecting a further slowdown to just 4.1% in 2027. This is a managed deceleration, not a sudden crash, and Beijing retains enormous state capacity to cushion the fall through fiscal transfers, special bonds for local debt resolution, and continued subsidies for strategic industries. But managed decline is still decline, and the mechanism matters. China made a deliberate bet. Pour state resources into frontier technology, AI infrastructure, chips, and robotics, and treat these sectors as the new growth engine to replace real estate. That bet is paying off on the export side, and Chinese firms genuinely lead the world in several of these categories now. It is doing almost nothing for the ordinary household whose wealth was built on an apartment that keeps losing value, whose local government can no longer fund services because the land sales dried up, and whose children are graduating into a job market that quietly stopped publishing its worst numbers rather than fixing them. The deeper issue is that China built 3 decades of growth on a model that required ever-expanding debt and an ever-expanding property market, and both of those levers have now reached their physical and financial limits. Exports can absorb some of the excess industrial capacity, but China is simply too large an economy for the rest of the world to buy its way out of a domestic demand problem, especially as more countries erect tariffs and trade barriers specifically aimed at Chinese overcapacity. Every additional percentage point of growth increasingly requires more debt to produce, and the return on that debt keeps shrinking. Meanwhile, the population is aging faster than almost any major economy in history, which only deepens the deflationary pressure Japan spent 30 years failing to escape. That is the real story behind the 4.3% headline. It is not a single disappointing quarter. It is a growth model quietly running out of runway, propped up by a technology export boom that is genuinely impressive but cannot on its own replace what the property sector used to provide, cannot rehire the young graduates the old system used to absorb, and cannot refinance the trillions of dollars in local government debt that keep compounding in the background. China is not falling apart. It is transitioning painfully and unevenly from a model that worked for 30 years to one that has not yet proven it can work for the next 30, and the households living through that transition are the ones absorbing the cost, while the export data gives the rest of the world reason to look away.